You've been saving for retirement your whole life. And every time you hear someone talk about tax strategies, you get excited, but then you come to realize, okay, that's only if you own a business. That's only if you own real estate. That's where a lot of the tax strategies exist while you're preparing for retirement. And you're right in a lot of ways. But if you continue with that thinking even after you retire, that's where your big mistake is. Because even though there's not a whole lot of tax strategies you can implement before retirement, once you're retired, there are a ton of tax planning opportunities, and if you don't take advantage of them, it could cost you tens or even hundreds of thousands of dollars. So in today's video, I'm going to share with you 3 tax planning opportunities that most retirees miss and show you what you can do to take advantage of it. Hey everyone, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. There are certain tax opportunities that you need to be aware of, because depending on what you decide to do with these, they could either save you or cost you thousands and thousands of dollars over the course of your retirement. That's why today I'm going to share with you 3 big tax mistakes I see a lot of retirees making so that you can avoid these in your own life. And be sure to stay tuned through the end, because I think number 3, you'll say, I've heard of that before, but there's some nuance to it that most people completely miss. The first big mistake is people don't fully utilize what's called tax gain harvesting. Tax gain harvesting is this. If you look right here, what you'll see is there are different tax brackets for capital gains, specifically long-term capital gains, than there are for ordinary income. And the bottom tax bracket for long-term capital gains is 0%. You can see here, if your income's under a certain threshold, you pay 0% on any long-term capital gains realized up to that threshold. Now, this is something most people are unaware of, and I want to give you an example of how you can fully take advantage of this. Let's assume that you and a spouse retire, and you're both age 65, you file taxes married, filing jointly, and you want to live on $120,000 per year. Well, $120,000 per year, that's pretty decent income, and most people might say that's probably going to cost you something in taxes. Well, it might, but it fully depends upon how you pull income out of your portfolio. Let's take a look. Let's assume you have a fairly substantial brokerage account. Let's assume that you bought a single stock for, let's say, $250,000 several years ago, and now that stock is worth $1 million. So what that means is of that $1 million, 75% of it is gains. Again, gains are what you pay taxes on, and 25% of it, so $250,000, is your own principal. So an amount you've already paid taxes on and you won't pay taxes on when you pull it out. Then let's assume on top of that, you also have a Roth IRA and you also have a traditional IRA. And so you're looking at your assets and you're saying, how do I create $10,000 per month and do so in the most tax efficient way? Well, there's many ways to do this, but let's look at one. Let's assume that right off the bat, you pull $30,000 from your traditional IRA. Now, I'm going to show you why in a second, but the short answer is your standard deduction for 2023 would be $30,700, which means your standard deduction is fully offsetting that $30,000 of income that came from your traditional IRA. Now let's assume you take the rest from your brokerage account. And every dollar that you take from your brokerage account, 75% of that is going to be gains. Because remember, $250,000 was invested one time into one stock. It's now worth $1 million. So 75 cents of every dollar you pull out is taxable. 25% is not taxable, just a return of what you've already put in. Now here's our goal. Our goal, again, looking at this chart right here, where we look at taxation of long-term capital gains, our goal is to keep our taxable income under $89,250. Because if you see that right here, if our taxable income is under that amount, we don't pay any taxes on those capital gains up until that threshold. And keep in mind, your taxable income is your adjusted gross income, which is a combination of all of your different income, minus things like 401k or IRA contributions, minus your deduction. So whether you itemize your deductions or take the standard deduction of $30,700 for this year, if you're 65 and older, that is your taxable income. So what that really means is our adjusted gross income can actually be as high as $119,950, because once we subtract out our standard deduction of $30,700, we are left with $89,250. And any capital gains below that are taxed at 0%, which we like. That means we can realize our gains and not actually pay any taxes on those gains. All right, so let's dive back into the example. Well, if we sell the remaining $90,000 from the brokerage account, Of that 90,000, 25% of it is just a return of what we already invested, so it's tax-free. 75% of it, though, that is taxable. And 75% of 90,000 is $67,500. So let's actually take a look at the tax report to illustrate how this whole transaction quickly becomes tax-free. So here's the example we're looking at. We're gonna call these people Joe and Sally Sample. They're the ones that wanna live on $120,000 per year, and they're taking $30,000 out from their IRA, and they're taking $90,000 out from their brokerage account, of which 75% is gains. So between the $30,000 of income from their IRA and the $67,500 of gains, most of us would expect there's going to be some tax liability to that. But let's take a look at why that's not the case. Here they are, so we're assuming this is for 2023. What we're assuming, no wages, I'm keeping this super simple, no other income. What you can see is they're taking $30,000 from their IRA here. They're taking $67,000, or I should say they're realizing $67,500 of long-term capital gains. It is important that I emphasize these are long-term gains because short-term gains are taxed at ordinary income rates. And then because they're 65 and older, they have a standard deduction of $30,700. So let's look at the tax report. What does this mean for them? Well, if we go here, we can see that their total income is $97,500. So again, we would expect there's probably some tax liability here. And depending on what state they're in, there might be, but I'm specifically looking at federal taxes right now. Well, of this $97,500, they can take a deduction of $30,700. So right off the bat, $30,700 is wiped out from their income. That leaves $66,800. Well, how does that get taxed? Nothing is taxed at the ordinary income threshold because the only ordinary income they had was that $30,000 from their IRA, and the standard deduction fully offset that. So they actually don't have anything that they're paying taxes on for ordinary income. But capital gains, if you remember that chart I showed you a couple minutes ago, what this is showing you is any income, any long-term gains that are realized up until $89,250 are subject to a 0% federal tax bracket. So because this income is lower than that threshold, not only is their IRA not subject to taxes because the standard deduction offset that, but these capital gains are not subject to taxes. So they're living on $10,000 per month or $120,000 per year, and you can see here the total tax is $0. Again, they may have state taxes. I don't know exactly what state Joe and Sally Sample are in, but at the federal level, there's nothing paid in taxes, and too many people don't take full advantage of this because they're unaware of how this works. Now notice I didn't include any Social Security income in Joe and Sally Sample's case, and I did that for a reason. Because Social Security taxation can get quite tricky quite quickly, and that actually leads us into mistake number 2, which is being unaware of the Social Security tax torpedo. Now, what on earth is a tax torpedo? That sounds like something we want to avoid. Well, what it is this, is Social Security taxation is based upon a concept called provisional income. Now, I'm including a video right here that I recorded previously. If you want to see how does Social Security get taxed and learn more about provisional income, click this here and then watch it once this video is over. However, in a nutshell, your provisional income is what determines how much of your Social Security benefit is going to be taxed. And what you can see on this chart here is this shows you based upon what your income is, or based upon what your provisional income is, how much of your Social Security benefit is included in your taxable income. Now I go into more detail in the video that I just referenced, but if you're looking at these numbers and saying those seem like really low numbers, number 1, you're correct, but number 2, not all of your income is included in your provisional income. For example, only half of your Social Security benefit is included in your provisional income. Or any Roth IRA distributions are not included in your provisional income. So the lower your income, the more likely you are to have less of your Social Security benefit included in your taxable income. So that's the foundation for why the tax torpedo exists. But as you can see from this chart that I'm going to put up here again, as your income starts to climb, it goes from having 0% of your Social Security included in your provisional income to 50% of your benefit included in your provisional income, up to 85% included in your provisional income. And it's kind of a sliding scale as more and more of your income starts to get picked up and included in your provisional income. So here's the catch. As your income is rising, Not only is that pushing you into a higher and higher tax bracket because of the income itself, but it's simultaneously pulling more of your Social Security income into your taxable income as well. So it's a double whammy here of you're entering higher tax brackets, and each dollar extra that you earn via a certain range or through a certain range is also pulling in more of your Social Security benefit. So the actual impact will depend upon your specific situation, but there's many cases where if you're in the 12% tax bracket, one extra dollar earned, you might think, okay, well, that's an extra 12 cents that I would pay in taxes. That's not the case. It's an extra 12 cents you pay in taxes on your normal ordinary income, but now an extra 85% of your Social Security income is also included. So depending on your specific situation, one extra dollar earned in the 12% marginal tax bracket might actually cost you 22.2% in taxes, because that 12% on the income plus 12% of an additional 85% of your Social Security that's now pulled into your taxable income. Here's another quick example using Joe and Sally's sample. So let's assume that Joe and Sally are retired, and here's their income sources. And using 2023 numbers and a standard deduction of $30,700 because of their age. Let's assume in this first example, they take out $6,000 from their IRA distributions, and their Social Security combined is $50,000. Well, provisional income, once they have the $50,000 from Social Security benefits, only $25,000 is included in their provisional income. All $6,000 of their IRA distribution is fully included in provisional income. So $25,000 plus $6,000, their provisional income is $31,000. What does that mean? Well, it's under the threshold of having 0% of their Social Security benefit included in their taxable income. So if we were to run a report on this, what we would see is their total income is only $6,000. Their adjusted gross income is $6,000 because, as we see here, here's their total Social Security, $50,000, but 0% of it is taxable because those provisional income thresholds. So that's all tax-free. And because that's tax-free, at least at the federal level, this $6,000 is the only thing they're paying taxes on, fully offset by their standard deduction. They're in a 0% tax bracket. Now, let's look at what if instead of taking $6,000 from their IRA, they took $40,000, and just quickly go through this. Well, at $40,000, now they are starting to push up into the provisional income thresholds. They're not yet at the point where a full 85% of Social Security is included in taxable income, but what you can see here is about 47% or so of their Social Security benefit is now included in their taxable income, and that's because of their provisional income. So now here's their adjusted gross income, deductions, and total tax, but this is where the tax torpedo starts to kick in. You can see here, one additional dollar of, say, IRA distributions would be subject to 12% taxes. Not just that, but one extra dollar of IRA distributions also pulls in another 85 cents of Social Security into their taxable income. So when you run the math, that extra dollar that you think would be taxed at 12% is actually taxed at 22.2% at the federal level. So be aware of the Social Security tax torpedo to make sure that's not offsetting any tax planning you're doing in a negative way. The third mistake people make in their retirement planning is this. They either under-convert IRA balances into Roth, or they over-convert their IRA balances into Roth. Now, for people who are unaware of the Roth conversion strategy, they typically retire with all their money in pre-tax accounts, and what they don't realize is that when their required distributions kick in, those might push them into a higher tax bracket. I think a lot of people watching this video understand that in concept and understand how that works. The other challenge that most people aren't aware of, and I see this risk too often in people who are aware of Roth conversion strategies, is they over-convert today. They're so cautious and so fearful, but what are those required distributions going to be, that they tend to convert too much of their IRAs and end up paying way more in taxes than they otherwise would have had they simply done nothing. Let's take a look at an example to illustrate what I mean here. This time our examples' names are Ryan and Jolene, and let's take a look at Ryan and Jolene's situation. They're looking to retire, and as you can see here, they've got a good amount of their money in pre-tax accounts. So Ryan has his pre-tax 401k plan, Ryan has his traditional IRA, Jolene has her traditional IRA, and all of these assets, once you start pulling them out of your portfolio, they're going to be taxable. So the challenge is understanding, when do we convert, when do we not convert, how do we manage this in a way so we're minimizing our lifetime tax bill and our lifetime tax liability? Well, here's how we do that. We take a look at Ryan and Jolene's tax bracket today, and then we project that out over the course of their retirement. And of course, this is going to be based upon what's their income sources today and how those income sources change over time as Social Security kicks in, as pension kicks in, as you're taking income from various accounts, whether they be IRAs or Roth IRAs or brokerage accounts. And what we start to see is something that might look like this. What this is showing is this purple bar is showing what's their total taxable income projected to be from today all the way until age 90. And what you can see is their taxable income is high today. They're both working, they're both earning an income, and that's pushing them into a higher tax bracket. Well, then they retire, and you notice there's a nice valley there. When they retire, if they start living on cash or their brokerage accounts that have mostly already been taxed, they might be in a very low tax bracket. So they're in a very low tax bracket for a long period of time. But then what happens is Social Security and pensions kick in, and at age 75, required distributions kick in. So you can see if they actually do nothing about this, in the future, they'll be in a higher tax bracket than they're even in today. So that's the risk of under converting. If they just sat there and did nothing, they're going to pay a whole lot more in taxes than they otherwise needed to. What we like to illustrate to people is something like this. We'll say, what would this look like if we filled up certain tax brackets? What does filling up a tax bracket mean? Well, it means in those early years where maybe your taxable income is very low, can we on purpose move money out of your IRA into your Roth IRA, but only up to certain limits? Say, we'd be happy paying 10% taxes or 12% taxes or 22% taxes or whatever the bracket might be, so that we don't pay way more in taxes in the future. Well, what does that do? Well, if we looked at it before, here's what their taxable income was projected to look like, versus now, you see that's been normalized and leveled out. And yes, they're paying more in taxes up front, but in exchange for that, there's a much lower tax liability in the future, and the net impact is that might save hundreds of thousands of dollars in tax-adjusted ending wealth. So the risk of under-converting is you're leaving a lot of money on the table. So that's one risk, is the risk of under-converting. Now let's go back to the base case scenario. So this was before converting anything, where they're effectively leaving maybe hundreds of thousands of dollars on the table. Here's what too many people do, where they over-convert. They look at this and say, oh my goodness, look at all those taxes I'm going to pay in the future. I'm going to convert lots and lots and lots of my account today. Well, let's use an extreme example. Let's assume they say, I want to convert everything today, or I want to convert up to the top bracket to start getting everything into Roth accounts so I don't have to pay taxes in the future. Well, if they do that, let me get the screen to refresh here. What you'll start to see is now all of a sudden, the strategy that they're taking leaves them with over $1 million less in their total portfolio value because they converted too much today. So there's a fine balance of how much do you convert today? How long do you convert for? Do you do this indefinitely throughout your retirement, or do you do it for the first 10 years, 12 years, 15 years? It should all be based on a unique strategy for you. But what you can see here in looking at the numbers is there's a risk to under-converting, but there's also a risk to over-converting. And too often, the people who are familiar with this Roth conversion strategy, I see them over-converting and actually cost them more money in taxes than they ultimately save over the course of their retirement. So it's impossible to understand today exactly how much you should convert every single year of your retirement. It's going to depend upon future tax brackets. It's going to depend upon investment returns. So how large or not large is your pre-tax balance growing? It's going to depend upon your spending, your other income sources. There's so many variables that this is something that should be monitored annually to make sure you're staying on top of this and converting the right amount for you. But the big mistake is either under-converting or over-converting, and either of those could be costing you, via either opportunity cost or extra taxes paid, hundreds of thousands of dollars or more. So those are 3 big tax mistakes I see a lot of people making. Now, some of these very much come down to the difference between how is ordinary income taxed versus how are capital gains taxed. Now, I made a video that I hope you'll check out right here, because one of the key things to understanding how you can minimize taxes in retirement is understanding how different types of income are taxed. So check out that video so you can understand the distinction and make sure you're employing the right strategy when it comes to your plan. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.